Good morning and welcome to TOI Japan Market Radio. I'm your host here in Tokyo, and today is February 17, 2026. This show is designed for global investors tracking Japanese equities, foreign exchange, and fixed income. Let's dive straight into today's session with our portfolio manager.
Thanks for having me. Today we're seeing broad-based weakness across Japanese equity indices. The Nikkei 225 closed at 56,566.488, down 0.422%, while the TOPIX fell more sharply, down 0.728% to close at 3952.0. The Mothers Index, which tracks smaller growth names, declined 0.219% to 2,275.0, and the J-Right Index dropped 0.59% to 2022.0. On the currency side, dollar-yen is at 153.066, up a modest 0.188%. In commodities, gold priced in yen fell 2.094% to 17,770.0, while crude oil gained 1.097% to 63.58.
That paints a picture of risk-off sentiment in equities but relatively stable currency markets. Let's turn to the main driver behind today's equity weakness. Headlines are calling it the SaaSpocalypse, a tech sell-off that began in the United States and has rippled across global markets, hitting both the S&P 500 and the Nikkei 225. Can you walk us through what's happening here?
Absolutely. What we're seeing is a coordinated downturn in software as a service stocks and broader technology names originating in U.S. markets. The sell-off has spread to Japan because Japanese equity markets have significant exposure to the global tech cycle. Companies like Sony, Advantest, and Tokyo Electron are major semiconductor and tech equipment exporters, and their earnings are directly tied to global technology capital expenditure. When U.S. tech weakens, it immediately hits Japanese tech and semiconductor names.
So this is less about domestic Japan fundamentals and more about contagion from overseas. What does that mean for investors who hold Japanese equities as part of a diversified global portfolio?
It's a reminder that the correlation between U.S. tech and Japanese equities remains quite high, which limits the diversification benefit many investors might expect. When risk sentiment deteriorates in the U.S., we typically see two things happen in Japan. First, equities come under pressure due to direct sectoral exposure. Second, we often see the yen strengthen as investors deleverage carry trades and seek safe haven assets. That yen strength can act as a partial offset for unhedged foreign investors, but it also signals broader risk-off dynamics.
And we are seeing that modest yen strength today, with dollar-yen up only 0.188%, which is relatively stable given the equity sell-off. Staying with the yen theme, let's move to another development that's influencing currency markets. U.S. Treasury markets rallied after the reopening, with the 10-year yield declining toward 4%. How does that feed into the Japan story?
This is quite significant for Japan because it compresses the yield differential between U.S. and Japanese assets. For the past several months, one of the key drivers supporting yen weakness has been the wide interest rate gap between the U.S. and Japan. Investors have been borrowing cheap yen to invest in higher-yielding U.S. Treasuries and other dollar assets, a classic carry trade. When U.S. yields fall, that carry advantage diminishes, and we start to see those trades unwind. That creates upward pressure on the yen.
So lower U.S. yields could actually trigger a reversal in some of the yen weakness we've seen over the past year. What does that mean for Japanese equities and Japanese government bonds?
For equities, it's a near-term headwind. A lot of the support for Japanese stocks has come from foreign inflows driven by carry trade dynamics. If those unwind, we could see reduced demand for Japanese equities, particularly from foreign investors. That said, exporters might benefit from yen strength if it remains moderate, but financials and domestic-focused stocks would likely underperform. On the JGB side, yields are likely to remain anchored or decline modestly. The Bank of Japan's yield curve control framework limits how much yields can rise, and lower U.S. yields reduce external pressure on Japanese rates. We could see the 10-year JGB yield compress further if this Treasury rally continues.
That makes sense. Lower U.S. yields give the BOJ more room to maintain its accommodative stance without worrying about capital outflows. On the policy side, there's another headline today that touches on trade and tariffs. Reports suggest that the Trump administration's broad-based tariffs on metals are starting to backfire, and there's talk of a policy rethink. Why does that matter for Japan?
Japan is a major downstream consumer of metals and a huge exporter of metal-intensive manufactured goods, including automobiles, electronics, and industrial machinery. Broad U.S. metals tariffs directly increase input costs for Japanese companies that either operate in the U.S. or supply the U.S. market. So if the Trump administration is reconsidering these tariffs, it could reduce cost pressures on Japanese exporters and improve their margin outlooks. This is particularly important for large-cap industrial and auto stocks, which have been hedging against escalating U.S. trade barriers.
So a rollback or narrowing of these tariffs would be a positive for Japanese equities, especially in the industrial and export-oriented sectors. What about the currency and bond market implications?
On the currency side, policy confusion or reversal in U.S. trade policy typically undermines dollar positioning. If the tariff rethink signals a broader shift away from protectionism, it could create downward pressure on the dollar and support yen strength. Additionally, if the tariff rollback is interpreted as risk-on, we might see further unwinding of carry trades, which would also be yen positive. For JGBs, de-escalation of trade tensions generally reduces inflation expectations and tempers growth outlooks, which supports demand for long-duration bonds. We could see the 10-year JGB yield compress if this tariff story develops further.
Interesting. So whether it's the Treasury rally or the tariff rethink, both narratives seem to be pointing in the same direction: yen strength and potential downward pressure on Japanese yields. Shifting back to equities, how should global investors be thinking about Japanese stocks in this environment?
I think the key is to separate short-term volatility from medium-term fundamentals. In the near term, we're dealing with cross-border contagion from U.S. tech weakness and some unwinding of carry trade flows. That creates downward pressure on Japanese equities and upward pressure on the yen. But medium-term, if U.S. tariffs ease and global tech capex stabilizes, Japanese exporters and semiconductor names could see improved earnings visibility. The challenge for global investors is that the diversification benefit of holding Japanese equities is limited when U.S. tech volatility is this high. You're not getting the insulation you might expect.
That's a fair point. The correlation between U.S. and Japanese tech has been quite strong, and that's something global portfolio managers need to keep in mind. As we wrap up, what are the key monitoring points for the rest of the week?
There are 3 things I'm watching closely. First, any earnings guidance cuts from Japanese exporters, particularly in tech and semiconductors. If companies start revising down their outlook due to weak global demand, that would confirm the contagion story. Second, any commentary from the Bank of Japan regarding financial stability, especially if we see more evidence of carried trade unwinding and cross-border deleveraging. And third, the direction of U.S. Treasury yields. If the 10-year continues to move toward 4% or below, that will have significant implications for dollar-yen and Japanese equities.
Those are excellent points to keep on the radar. To summarize for our listeners, today's session saw Japanese equities decline on the back of a global tech sell-off, with the Nikkei 225 down 0.422% and the TOPIX down 0.728%. The yen held relatively steady at 153.066, but we're watching for potential strengthening if U.S. yields continue to fall and carry trades unwind. On the policy front, a potential rethink of U.S. metals tariffs could ease cost pressures on Japanese exporters and support industrial stocks. As always, no specific investment recommendations here, but these are the themes global investors should be tracking as they manage their Japan exposure.
Well said. It's a dynamic environment, and staying on top of these cross-border flows and policy shifts is critical for anyone with exposure to Japanese markets.
Thank you for that comprehensive overview. If you follow Japan's markets and want daily insights like this, consider subscribing to TOI Japan Market Radio. We'll be back tomorrow with another briefing. Thanks for listening.